Sandler's Alexander Potter expects that Tesla will deliver 507,000 vehicles in Q4, which sounds a bit optimistic to me. And actually, he himself admits that this is on the high end of the believable range. Troy, for example, is only at 477,000, but I expect him to increase his estimate by a little bit because of the good numbers from China. Piper Sandler also noted that it is optimistic about the company's margins and that the margins in Q4 are going to be higher than in Q3. And at first, that sort of doesn't make sense because didn't Tesla reduce prices a little bit? I'm talking about inventory discounts. For example, in Germany, Tesla lost an EV subsidy, but it replaced it with a discount coming directly from Tesla. So that certainly hurts the margins. But also, if you remember, Tesla increased the prices by a little bit in China. And perhaps most importantly, if you look at China, Tesla is selling so many more Model Ys than Model 3s, which also is a tailwind for Tesla's profitability compared to previous quarters. So while Piper Sandler is optimistic, I think there is a reason for them to actually be optimistic. Morgan Stanley has a new Tesla stock note. Here are some key highlights. Many investors still debate the merits of Tesla as more than an auto company. In our opinion, Tesla is definitely an auto company. It is also an AI company, think and not or. Morgan Stanley is actually making a lot of sense here. Tesla's AI Day will be an important catalyst to introduce and develop new adjacencies for Tesla's technologies. Optimus addresses the $30 trillion global labor market and runs on the same software architecture as FSD. In other words, if you include FSD in your Tesla model, it is very likely that you are not including all of the upside from the bot that you probably should include in your model. Because if FSD works, then the Tesla bot will also certainly work to some extent. Then they talk about Dojo, the same forces that have driven AWS to reach 70% of Amazon's total earnings can work at Tesla. In our view, opening up new addressable markets that extend well beyond selling vehicles at a fixed price. The catalyst? Dojo, Tesla's custom supercomputing effort in the works for the past 5 years. Morgan Stanley seems to be really convinced about Dojo. I'm a bit less optimistic about Dojo because Elon himself said earlier that it's a long shot, but it's still worth pursuing. And we pretty much know that Tesla is throwing everything it has at full self-driving, but is Tesla really throwing everything it got at Dojo as well? I'm not so convinced about that. It's more like a side project for Tesla, but it's a side project that could actually turn into a huge business, so we should still pursue it. As traditional OEMs pull back on their in-house vertically integrated EV plans, we believe Tesla is in a position to add even greater value to industry rivals in areas such as software, FSD, battery, hardware, operating system, 48-volt electric architecture, and other areas. Now this one is pretty interesting. SpaceX and Starlink halo effect. From our discussions with investors about Tesla, the subject of SpaceX and especially Starlink are seen as important components within the Muskonomy and ones that are potentially interrelated with Tesla itself. SpaceX recently launched a huge rocket to certainly some degree that has been a huge success. Morgan Stanley thinks that helps Tesla too. I agree to some extent, certainly. In our opinion, Tesla is far more than an auto company. Of our $380 price target, our valuation of the core auto business is just $86 per share. I think that number should really be higher, but their delivery expectations in 2030 are really low, leaving 77% of our target derived by network services, mobility, third-party battery, FSD licensing, energy, and insurance. From 2023, Morgan Stanley is forecasting that Tesla's earnings will grow at a 27% compounded annual growth rate through 2030. While it's important to factor in near-term real-time headwinds into 2024, we believe it is also important and reasonable to consider the long-term potential of the products and services being commercialized by the company. This actually makes sense now. They should actually look at everything that Tesla is going to do and include everything without being extremely overly conservative? Because Morgan Stanley's Tesla stock record, well, it's a bit hilarious. The timing almost could not be worse. I mean, Morgan Stanley said to hold while you should have been buying as much as you could. They said sell while you should still have been buying as much as you could, and they said buy. When, I see why maybe possibly you may not have wanted to buy as much as you possibly could have. But hey, look, overall, it still has worked out for Morgan Stanley. Their success rate is about 56% with a return that's above 0%. But you are better off listening to Alexander Potter, who has been pretty much always right about Tesla stock, with his returns averaging 107% per Tesla stock rating.